Hi, everyone. My name is Inara, and I'm a part of the Building Momentum host committee and also a research analyst with Stanford Latino Entrepreneurship Initiative. Hope you enjoyed all your previous sessions, and we now have an excellent conversation lined up for you on venture fundraising and how to make it work for your company. Leading the discussion today is Elise Smith, co-founder and CEO of Praxis Labs, a company making society more equitable by advancing workplace inclusion and belonging. Elise, I'll hand it off to you now.
Thank you so much, Inara. I am so thrilled to be here in conversation with panelists Ryan, Dina, and Charles. I will let each of them introduce themselves shortly, but before diving in, just wanted to share who I am and what our hope is for this session. So I'm Elise Smith. I'm the co-founder and CEO of Praxis Labs. Praxis Labs is a learning and development company that's focused on making workplaces more equitable and inclusive. We pair immersive learning experiences in virtual reality and mixed reality with learning and reflection on our platform to provide actionable insights to our clients, Google, Target, Uber, eBay, as well as their employees or our learners. We recently announced our seed round with amazing funders, including Charles at Precursor, and we just launched our flagship learning journey, Pivotal Experiences. But enough about me. My hope and our hope for this conversation is that we're able to provide folks on the line real value and real insight into how to access VC funding. I started fundraising out of Stanford. I was getting an MBA. And even after taking classes that were literally called Entrepreneurship and VC, I still found the fundraising process opaque, challenging, exhausting, and confusing. And so that's why I am so excited to be a part of this conversation, to glean the brilliance and insight from Ryan, Charles, and Dina. And so without further ado, I'd love to have you all introduce yourselves. Dina, maybe you could kick it off for us.
Absolutely. Thank you, Elise, for the kind intro. And so much fun to be on a panel with some of my favorite investors and to get the chance to connect with all of you at the GSV. So thanks for having me. By way of introduction, I'm a partner at Lux Capital. We are a multi-stage venture capital firm, started about 21 years ago, focused on contrarian, rebel entrepreneurs who are taking on some of the most challenging problems. Over the last several decades, this has come to be known as frontier tech, otherwise known as deep tech, hard tech, call it what you will. But when we started 21 years ago, there really wasn't such a clear venture return profile for these types of businesses. So our founders, Josh and Peter, in their early 20s, probably perhaps even younger than some of the folks who are dialed in today, had this notion that there was a really unique opportunity to invest in the earliest days of company creation in these types of founders who were trying to turn science fiction into fact. And we've evolved quite a bit over the years in this scope and size of our fund and investments. We now have 2.5 billion assets under management. We are investing out of our sixth fund, venture fund, which is a $500 million fund, and our second opportunity fund, which is 550. So we have the ability to invest in everything from pre-seed all the way through growth, with our sweet spot really being Series A, Series B, where we prefer to lead and take an active role on the board. I joined about a year and a half ago, very non-linear background, and just not your usual VC. So I can share a bit about that quite briefly, and I'm happy to answer questions. Started off, well, I'll backtrack. Stanford is actually the reason I am where I am. My parents immigrated from Iraq. Father made his way over to Stanford for his residency in psychiatry. So I grew up in and around the Bay, a rare Bay Area native, and went to school on the East Coast. Not Stanford, because my older brother, who's only a year older than me, went there. And so I needed to chart my own path. But I can tell you every winter in Cambridge, I was like, what the hell am I doing with my life? So definitely had a lot of that FOMO. I studied probably the least technical degree you could possibly get, social studies and Near Eastern languages and civilizations, was always orienting my kind of career journey around impact. Having grown up Arab and Muslim and American, and been in high school during 9/11 and the war on Iraq, I've really found myself living in that hyphen and constantly building bridges. And so that's what I thought I wanted to do, and ended up going to grad school at Georgetown, thought I was going to do a PhD, was pursuing journalism. And this was just a side hustle while I was in school. And that's what actually landed me in government. Worked for President Obama, as you might see in the cameo over here in the background. I was helping to cover a speech he was giving in 2009 about the role of technology and entrepreneurship in building bridges. And that is with the Middle East in particular. And so that's what compelled me to join the administration. I spent several years there. During that period of time, was coming out to Silicon Valley a lot. And this was sort of the first wave of what we now call the fourth industrial revolution. And also was seeing what was happening on the ground with the Arab Spring, and felt compelled to learn how to build product and make my way back to the Bay. So joined Google, spent a few years there, worked on a bunch of cool moonshot products, many that never went anywhere, some that did, led their healthcare efforts, and recognized over time the real innovation was actually not coming from within big tech, but from these early stage startups. And so that's how I landed in venture. I'll stop there because that was a lot.
Dina, oh my goodness. This is a hard intro to follow, but Ryan, maybe you can jump in and share your background.
Yeah, so maybe I'll just share my Stanford connection. So I originally started at Stanford, actually as an undergraduate research student. That's where I met Charles. So Charles and I met, I mean, now Charles, this is dating us a little bit, but at 1999. So I basically, Charles was my inroads to I was like, what is going on here? I was a scientist. So I was doing research on brain tumors, right? And so I was like, what is going on here? What, like these companies and all this other sort of stuff. So Charles really kind of plugged me into oh, well, this is, and he was already involved, he was investing. I'm sure he'll talk about that. He was doing a bunch of really cool stuff at the time. I was just a scientist, right? So that was my first interaction with Stanford. My second major interaction was actually the Latino Stanford Business Scaling Program, which was very, very helpful as we were scaling our business Wild Earth. So just to give you a little bit more of my business background, so I came up through clinical research in business development as well. I co-founded a biotech accelerator in San Francisco called IndieBio. We accelerated and funded 80 biotech companies. About 30% were future of food, which is probably what we're most famous for. 70% were hardcore gene therapies, cancer therapeutics, companies like hard tech. I would describe that. I think some of the future of food companies, I love them, but I don't view them as hard tech as cancer or gene therapy or some of these other applications. We were the first investors in companies like Memphis Meats, so the cell-based meat company. That was very interesting. At the time, people told me that was science fiction. I left, started Wild Earth, which is now the leading healthy plant-based pet food company in the US. We scaled sales 700% last year, which was fun. We have 25 people throughout the US. We actually have 2 headquarters, one in Berkeley, California, and one in here in the Triangle in North Carolina. So Raleigh, Durham. In parallel, I've continued to be an investor. So I'm a partner at Babel Ventures, which is a consumer biotech fund. And I also started a small micro VC fund. It was the first future of food rolling fund on AngelList, which we invest in really the first check, the first 500K to 100K to help entrepreneurs get off the ground. And we help entrepreneurs, where other people won't necessarily cut them a check. So whether they're in the US, whether they're in South America, Africa, Asia, that's the places I like to go. I like to go to the places where, it's kind of scary for other investors to go. I'll go there. Because it's the most interesting thing you can do, right? So one of my favorite investments at the moment is Veggie Victory, which is Nigeria's first plant-based meat company.
Wow.
Right. So it's kind of wild. So continue to scale. Happy to answer it with my entrepreneur hat on or with my investor hat on.
Yes, Ryan, it is clear we will learn a ton from you. This is going to be amazing. Charles, do you want to introduce yourself as well?
Yeah, hey, thanks for having me. I'm Charles Hudson, managing partner of Precursor Ventures. We're a pre-seed venture firm based here in San Francisco. I started the firm 6 years ago, kind of very much in the vein of what Ryan described. I'd been a partner at a larger seed fund called Uncork, which used to be called Softtech. When I got there, we wrote these 100K checks. My partner, Jeff, had started it from scratch with his own money. We had this terrible little office in a trailer off of Lytton Avenue, and we moved up the big time to working out of a house in downtown Palo Alto. That firm scaled from 16 million under management when I got there to now they have more than $500 million under management. And what I realized is that like the environment at the early stage, it's really a function of how much money you've raised. And I think when we had a small fund, we were able to write 50, 150, 200K checks. The people that I would say really, we just thought they were smart. They didn't really have much in the way of evidence, but we believed in them. By the time I left, we'd gotten to a point where our average check was $1 to $2 million, and we wanted to see a product and a financial plan, and it was a lot more rigor. And I just felt like there was this pool of entrepreneurs that weren't being served because they couldn't check all those boxes. So I have a lot of connections to Stanford. I am an undergrad in sort of like Dina. I thought I was going to get a PhD. My PhD advisor advised me that was probably not in the cards for me personally in economics. So I studied econ and Spanish, came back to the GSB. So I'm undergrad class of 2000, GSB class of 05. I also now am a lecturer at the GSB. So I just finished my second year of teaching with the class focus on entrepreneurship, where we were fortunate enough to have Elise come back as a guest speaker this year and share all of her wisdom. And I've spent my career sort of going back and forth between venture capital and operating. So have been on the investing side at 3 firms, InQtel, the CIA's venture capital group, Uncork, and now Precursor, but I've also been on the operating side at companies like Google, worked at a company called Serious Business. That was a games company that was acquired by Zynga, started a games company of my own, ran some non-venture backed businesses, and happy to talk about those too. And also had a brief stint as an interim CEO for one of my portfolio companies as well. So really enjoy talking to people about the process of starting up and the right capital to put behind you. And so, we'll do 30 new investments a year. So we have this conversation with lots of teams about how to think about finding the right kind of capital that's aligned with your vision and strategy.
Well, thank you so much, Charles. Like, wow, honestly, we could just keep having you guys just talk and it would be really, really valuable. But just to drive, I think all of you mentioned some sort of connection to Stanford. And I think a lot of folks on the line might have a connection, but they may not. They may not have access to this world and this environment in which startups are just, and funders are your professors and all of these different things. And so starting at the basics, like how and when is the right time to think about venture capital as a source of funding? I've heard the story of an idea on a napkin. Like, Charles, can I come to you with a napkin and are you going to give me 50K? Ryan, is that possible? And so would love to just hear from you all around, like, what are the attributes of a business that make it venture fundable? When is the right timing? Charles, you mentioned there might be some metrics or evidence needed. What is actually needed to even consider getting started in venture or with venture? And I'll let whoever wants to jump in go first.
Charles, maybe given the name of your firm, Precursor, and how early you go, maybe we can start somewhat chronologically with your perspective and we can chime in.
Sure. I think so we invest in really idea stage companies. There's no requirement that you have a launch product. There are some requirements. So one requirement is you have to be committed to working on the thing that you're going to raise money for full time. For me, that's really important. Like, this has to be your primary professional outlet. The few times I've deviated and said, someone's like, oh, I've got a couple of things. This is one of the startups I'm working on. You should put money in it, or I'm going to start it, but I'm going to recruit someone else to run it. Those have not worked well for me. So our process is very focused on 2 things. One, is the founder willing to make a full-time commitment to this project? And not everything that people work on needs to be a full-time commitment. So that's one. Second, does the founder understand what they're signing up for when they ask for venture capital? So, I'm in a business where the goal is to find really outsized returns. And like, what does that mean? That means I'm trying to put in a $250K check today that sometime in the future could bring back 40, 50 million bucks minimum, which means I need businesses where the founder has a vision of building something that's really, really large, where I'll end up being a pretty small owner in the end. But you have to have a vision for building something really big, and where access to capital early in your life would make a difference. So there's some businesses like real estate where like capital is a requirement to play, but having more capital early on may or may not change your trajectory long-term. Whereas for software businesses, which is mostly what I invest in, having 500K from day one means you can hire, but barrier price is probably 2 engineers to work with you, and you'll be able to build much more product more quickly than the person who's trying to bootstrap. So a lot of what I'm looking for in the early days is, does the person have the commitment to the product or company they're trying to build? Do they understand what's the scale we need to achieve jointly in order for us to both be happy with the outcome? And really, do I think it's an idea that has the merit? And just to give you some idea, we'll make 30 investments a year out of 3,500 companies that approach us. So, the majority of the companies that we say no to are companies where some combination of the scale of the thing that they want to build doesn't quite clear our bar. Or maybe I feel deep down that the founders, part of what you're doing when you raise money too, is you're allowing an investor like me to have a say in your business. And sometimes I meet people and I tell them, I think you would just be happier if you had total and absolute control over this business and could run it just the way you want. And maybe that means it's a slower growth path, but with fewer voices around the table.
That's super, super helpful, Charles. Ryan, it looks like, I know that you are also an investor and especially in these earlier stage companies, that first kind of smaller check. I'm curious how you think about what is necessary to be venture backable. What are the measures or evidence that you require when you think about making an investment?
I think from the outside, some investors in Silicon Valley probably think I'm absolutely crazy, the things that I do, right? Because I will back entrepreneurs, as Charles was saying, at the idea stage. It's not like I haven't looked at what they're doing. I've thought deeply about it, but they don't necessarily have to have a massive pitch deck, a big business plan, a financial model. That's not what I'm looking for. I'm looking, as exactly as Charles said, I'm looking for someone who has an idea which could transform the world, right? For the better, right? And so that is, and usually it's with science. So, an example of that is, I backed a company called Catalog Technologies. They store digital data in DNA, right? So it turns out it's about 1 million times more data dense to store digital data in DNA. That was one of the companies that we backed at IndieBio. Another example is Shiok Meats. So I was the personal first investor in a company called Shiok Meats. They're now Asia's largest cell-based meat company. I cut them their first check. And they had an idea. And so Sandia, she was an incredible entrepreneur. She had a great co-founder, Kai Yi. They were struggling to raise money from a more conservative Singaporean investment scene. And so I was like, okay, well, look, so the first thing I look at is, are the founders credible, right? And in science, typically, they've mostly spent their lives doing the things that you kind of want them to do. Like, they've spent their lives getting their PhDs, like understanding stem cell biology, understanding how to, like, their postdocs, right? Like, they have credibility within the space. So it's like, they have credibility, they understand the level of the challenges, usually the types of startups that I back. So I don't back, Nobel Prize winning science. I back people who are basically taking tried and true biology or technology and applying that to a specific and interesting business challenge. And like that's kind of it. And what's interesting is, there are entire industries, particularly within biotechnology, that, one molecule could lead to multiple industries, right? As an example, photosynthesis. That is literally industries once humanity starts to uncouple and open those things up. And so for me, I look for founders with a very powerful vision about how they can transform the world for the better. And usually the founders I talk to, the ones that I'm not interested in are the ones that can tell me, oh, I'll improve this by 20%. I want to see you change the entire game. Right? So whether that's cell-based meats, whether that is, that is storing digital data and technology, that whether that's curing cancer, at least having a strategy to cure a specific type of cancer, like that's what's going to make me work till 12 o'clock at night, 1 a.m. in the morning, and help these founders, because they're doing something that's meaningful. And they're gonna bleed for their company, and so will I.
Ryan, that's super helpful. And it sounds like what I'm hearing from both you and Charles is this focus on the founder, the credibility, the commitment. And then this idea, is it big enough? Is there an impact that's going to really change the game? Dina, I'm curious, when folks come to Lux, when they come to talk to you, are there other things that you're looking at, metrics or evidence, or other pieces that, if have an idea, what barrier do I need to cross to be relevant and viable to you?
Yeah, great question, Elise. Just to, in case folks missed the intro, we are a multi-stage fund. So obviously the sort of rationale, the calculus around whether or not we're going to invest will be different depending on the stage. Oftentimes either find an entrepreneur or identify a white space via a previous investment and can incubate and bring together a team at the earliest days. We've done that a number of times quite successfully. We can also invest as late as growth. Examples in recent months include Everly Health, formerly Everly Wall, and Benchling, both of which we did at the growth stage. So it really depends. It's certainly much more from a metrics perspective to look at if you're making a growth stage investment, and very little, if not any, metrics to look at from an early stage perspective. So at the end of the day, across the board, early, late, middle of the ground, it's about the team. It's fundamentally about the team. Of course, the idea, the concept, the market, et cetera, is important, but we don't invest in ideas. We invest in people. And so that is a big part of what we look for. And we all have sort of our own perspectives around what makes a remarkable N of one, if you will, founder, CEO. For me, some of those include grit, resilience, EQ, a diversity in their background. And by that, I'm not talking about demographics per se, although I do know that that intersectionality is something that, just looking at the data, makes better leaders and better companies. But what I also mean is somebody who knows how to work across sectors and fields, because that is a lot of what being a CEO is. You need to understand how engineering works, but also know how to handle press and how to deal with a product launch and how to do fundraising. And that doesn't mean you have to have done all of those things, but there is sort of that innate ability to and comfort with the flexibility and being a Jill of all trades. That's really important. So those are some of the things. And then also storytelling. And that's something that's gotten a lot of bad reputation over the years. Storytelling is not a bad, storytelling is a critical component of being an effective CEO. Why? Well, it de-risks some of the biggest things that you need to be a generational business. You need to be able to storytell to raise money. You need to be able to storytell to hire. You need to be able to storytell to sell commercially. And you need to storytell to get, if you're a consumer company, to get consumers. So I always like to think of, and I sometimes ask founders, and my partner Josh does this too, especially for the deep types of science companies that we invest in, explain your company to my 5-year-old. Sometimes if it's a really complicated company, I'll say 9-year-old, but I don't have a 9-year-old, but that is something that's really critical and has proven to be very important for founders, particularly scientific ones.
That is so helpful as well, Dina. Again, this focus on that founder, the focus on these characteristics that make up that N of one. I love how you describe it, that Jill of all trades. I'm curious for folks, who aren't in the Stanford network and bubble, who maybe they are that first-time founder, they're going for it, they have an idea, and maybe they have even a little bit more of that evidence, they have some numbers behind them. What are the unwritten rules of fundraising, right? Let's say you do get that meeting. I remember people were like, one, don't announce that you're fundraising. And it's like, what? But how am I fundraising if I'm not announcing it? They're like, just don't tell anyone you're fundraising. I'm like, but then how do I get money? And they're like, they'll just give it to you. And I'm like, is that real? So I'm curious, is there's this language around it. I'm curious if you guys could share some of those unwritten rules that you've seen on the inside as a VC or a funder or as an entrepreneur, since I know a lot of you have done a little bit of both. Ryan, maybe you can start.
Yeah, I mean, it's a dance, right? So everyone has a different dance and you have to dance with people very differently, right? And so I think, when you're raising money, there is no one way to raise money. And I've had this conversation actually with a lot of entrepreneurs that are outside of Silicon Valley, right? Kim from Initialized Capital had a really incredible insight that now the second destination for startups is actually in the cloud, right? And so things have changed from, literally about a year ago, pre-pandemic, to where we are today, where, today the rules are different. Like, it is possible to get in front of a lot of great investors globally with Zoom. And so, there are a lot of founders, a lot of portfolio companies I've had and companies that I've helped, just generally helped some founders get off the ground, where they've raised money globally through Zoom. and they've raised it in geographies that typically we're not able to raise money, right? And so that has been very different. And I would say it's only happened in the last year that that's possible. And I think one of the common misconceptions that founders have is that people will just fall in love with their idea. And it's just, that's a nonsense thing, right? It's like, you got to target the right investors, like people who are interested in the same space that you're in, target them. Like, I wouldn't recommend like a deep biotech founder goes to Charles and pitches him on some B2B or cancer therapeutics thing where he'll get his money back in 15 years, because that's a bad idea. Charles invests in software. Don't go and hit up Charles if you're a biotech entrepreneur, but definitely go and hit up Dina, because like she might actually invest in your startup, and she'll get the right people to assess it and analyze it and see if it's the right fit. And so like, these are the types of things that you have to really like weigh as an entrepreneur. I think a lot of founders, first-time founders, you know, they're like, oh, well, investors are investors. And it's like, it's just not, you wouldn't go and ask a bank for a loan if you were buying, you know, if you're trying to build a company. It's the same kind of thing. It's different investors for different types of investment.
Thank you, Ryan.
You're welcome.
Charles, any insider tips you can provide?
One of them shouldn't need to be said, but it does, which is like, don't lie. And I think sometimes when you hear these stories about these entrepreneurs who told these fantastical tales that were like not entirely true, I think one of the things I find people who are new to the ecosystem struggle with is like the difference between a lie and something that could be true if everything went your way. So a lie is like, we have a CTO and you don't have one. And you've got to pick, and this happened, I've had this happen. Like, I literally had someone present me a deck with a picture and a name on their team slide with someone that I know. And I emailed that person. I was like, hey, do you know that this company has you on their slide? And the person's like, I'm not a team member, I'm an advisor. And I don't really, and I was like, well, I automatically can no longer believe anything. And it wasn't necessary. If they had just said this person's an advisor, wouldn't have been an issue. So number one, don't lie. And I say that because I do feel like outside the ecosystem, it can be hard to figure out like, well, where's the line? Like, a lot of this is like telling a story about the future. And I would say if it's a lie, then it shouldn't be in the pitch deck. And it doesn't happen that often, but it happens enough that I feel like that's one of the inside things. Like, don't do that. Don't let anyone tell you that that's like a good strategy. Second, I want to pick up on what Ryan said, which is that there's a difference between like what investors say they're open to and what they really do as a core strategy. So if you meet someone who's like, we're a multi-stage fund that mostly does Series B round of investments, which are for companies that are way more mature, you should take them at their word. What it really means is like, we will stretch and make an exception for somebody who's earlier than that, but left to our own devices, we like to find companies that are farther along. And a lot of the frustration and wasted effort I see from people is they said, I'm at the idea stage and I'm from outside the valley and I'm pitching all these big Series A funds and they're telling me no. I'm like, well, of course they're telling you no. You don't have what they're looking for to unlock a yes. And so I think and it's a lot easier today to get smarter on what people are looking for. And from both a stage and a technology standpoint. So that's the other thing. The last thing I'll say is that like, I think one of the biggest sort of mistakes I see people make from outside the valley is understanding how the amount of money you ask for, like what that signals to the person that you're going after. So if someone comes to me and says, we only need $100,000, my immediate reflex is like, well, then it must not be that big of a problem. If you could make meaningful progress on this with 100K, like, well, it's a lot of money in the real world. In the venture world, 100K is like not a lot of money. And so like, to me, that makes me wonder like, hey, either A, does this person have a realistic view of how much it's going to take to build this company, or B, is this just a small thing? And so there is a whole art of like, if you want to raise $3 million, maybe you go out at 2.5 and allow the market to sort of bid you up to 3, and then everyone feels great. And like the one last thing I'll say is, I've told a bunch of our portfolio companies this: if you go out to raise $3 million and you start off at 2 and you end up at 3, everybody's high-fiving and feels great. You're oversubscribed by $1 million. If the number on the cover of the deck was $4 million and you end up at $3 million, everyone feels like the fundraising wasn't that successful, but you ended up with the same amount of money. And so I would say like the trajectory and the path you take to get to the number that you decide to raise does influence how investors feel about participating in that round. So there's a bunch of other things I could say, but those are some of the big ones.
Those are so helpful. I love that, even if you're raising the same number, how it's framed or that how it was positioned to begin with will change how it feels for everyone involved. Dina, I'm curious if there's any unspoken rules that you're familiar with, maybe even for folks, especially those underrepresented or underestimated founders.
Yeah, absolutely. And it's such gems of wisdom from Charles and Ryan so far. So definitely underscore all of that. I think, and some of this might be very basic, but it's worth saying, and things that I wish I had heard earlier on, both on the entrepreneurial side as well as on the venture side. Number one, do your homework. Unless you feel good about a venture, investor coming to your meeting without having any idea who you are or what you've done, you should do the same. And that means look through, it really takes 5 minutes. You don't necessarily need to go read their biography, but most of us are pretty public about a lot of stuff that we do. It's part of our job. Look at our Twitter. What have we talked about recently? Look at articles that we've written. Look at our firms. Are you pitching a company that is a direct competitor to something we've already invested in? That's a waste of your time. Those are all just like basic kind of thoughtful things that really can make that initial meeting and frankly the initial outreach that much more successful. So that's number one. Two is around the sort of the framing of the pitch. I think early on. This is a tough one. I think things are so crazy, which is what all of us VCs when we get together spend 5 or 10 minutes talking about. 100% agree with Charles, don't lie, but that also means don't bullshit. Excuse my French, but like we know what you're saying when you say, we're expecting term sheet. We know that founders know the magic words to try to get our attention, but it's a dance. I think that's what you said, Ryan, or somebody had said earlier, like it's a dance, and let's not play games. Personally, I'm very transparent, candid, and forthcoming. I don't like those games. I prefer not to play them. It's just wastes everyone's time. So that's how I roll. And I jive better with founders who can resonate with that. So those are a couple of things that I know that founders will give each other advice like, oh, here's what you say, and you'll get them to respond right away, and da-da-da-da. Just be authentic, be real. If you have a term sheet, you have a term sheet. If you don't have a term sheet, don't say you have a term sheet. If you have a CTO, you better have that CTO. Reputations are everything in this industry, and that goes both ways, obviously. And so that's why it is our job to meet with founders all day. And if we are rude or dismissive or aren't paying attention and are sitting there doing who knows what while we're in the meeting, that's going to be bad for us in the long run because everyone talks. But that goes both ways as well. And similarly, it's not a good idea if you're meeting with a firm that has multiple partners to copy and paste the same email to everyone. We all talk. It's a partnership. It's called that for a reason. So be targeted about who you want to talk to and why you want to talk to them. And that will go a long way.
I love that last piece of advice, Dina. I think it's so, as an entrepreneur, you are trying to reach as many people as you can. You're trying to get all the meetings on the calendar. And it's like, no, don't you make it targeted, make it specific. That's so smart. And
then when you move too quickly, you copy and paste the email and you put the competitor's venture fund in that email, and it's funny, but also bad first impression.
That is super helpful advice. Thank you all so much. I want to make sure that we have some time for folks who are on the line to ask their questions. So we'll be monitoring that chat. We actually have a question already. And Ryan, you kind of started talking about this. What are the changes that we're seeing in the VC ecosystem? What are those implications for entrepreneurs who are hoping to raise funds?
Yeah, I actually noticed, I think Peter also said that, show me the VCs where money is easy, because everyone he knows he has raised, it's always hard to raise or something like that. It's always hard to raise. Like, everyone looks out and goes, oh, it's so easy for that company and that company to raise. You don't know their story. You don't know what they've gone through. Like, it is grueling. Almost every entrepreneur I've ever met has said it's been grueling to raise. It always is. Even the most successful entrepreneurs. One of my favorite stories is, Facebook had a down round once. Most people don't realize that, right? So like it is rough for everyone on this journey. And so don't think that you're the poor you, poor me. I'm the one that didn't. It's like, it will be rough. That is part of the journey. It's going to be hard. It's going to be like, that's your grind. That's your grit. That's how you push through it when it knocks you down. So how have things changed? And, I know both Charles and Dina can speak to this, but I've noticed, especially for the very earliest of stages, getting that first 50 to 100K check, that now actually we're seeing an emergence of angels, micro VC funds that are global, and they're starting to cut checks. And so now we're seeing a lot more early stage activity. I think it's probably never been a better time to be a venture backable entrepreneur. And there's a very specific term to that, venture backable, i.e., don't start an ice cream shop on the corner of the corner of High Street, right? The main street. Like, that's not venture backable, as Charles was saying around real estate, but like something that is very scalable, global business, because you can raise. There are now incredible platforms. I mean, Republic is blowing my mind with how much money people are being able to raise, even from crowdfunding. Right? There's probably going to be a bunch of garbage companies that are funded that way, but there might be a couple gems that come out of that. And so I think we are looking at a change, a global change. In the past, it was basically, for the sciences, it was San Francisco and Boston where you could raise money. And I would say it's now increased to, before the pandemic, San Francisco, Boston, New York, and LA. But I think now we're seeing a global picture that founders can actually get investment globally, right? In most places. Which I think is really a powerful trend. And I think we're going to see an increase in innovation. I mean, even YC's batches are like 350 teams or something globally now. That's amazing. It's amazing.
Yeah, that I think it's super exciting time to hear that now is a great time to be a VC backed company. So it should be easy, but I love that paired with the first part where it's like, it's actually going to be hard no matter what.
It's going to be brutal. It's going to be brutal. I guarantee you, your experience will be brutal no matter which path you take. Enjoy.
Dina, anything that you're seeing in terms of how the landscape is changing and what that means for folks looking to raise?
Oof. It is definitely a good time to be a founder. That's for sure. And I think at least speaking for myself, I have seen more quantity and better quality founders in the last year, certainly than all the other years combined. It's remarkable. It's exciting. It's exhausting. It's fun. So that's great. And I think just, knowing that literally everybody and their mother is investing these days. So capital is out there, and being strategic about who, how much, and what you're using it for, as opposed to just raising for the sake of it, is really important, because there may be a lot of heat right now, but heat doesn't last forever. And making sure you have the right folks around the table, and that those folks will be there with you through thick and thin and will continue to support you is critical. And I think Charles knows exactly what I'm talking about right now.
Dina and I are dealing with one of those right now.
Yes.
I'll say something a little different, which is like, there's this paradox right now where there's a ton of capital in the ecosystem, but it feels like increasingly more and more of that money is going to a smaller and smaller handful of companies, which is this weird paradox for entrepreneurs, which is you read about these huge venture funds and the amount of money being raised. And I think what's happening is, 5 years ago, I think most of us felt writ large, like $1 billion company was a big deal. That was like the whole point of this unicorn thing, was to get into $1 billion was this very rare milestone that very few companies could achieve in the private markets. And now we've reached a point where $1 billion is not a shrug, but you're kind of like, okay, another, there's another one. It's not like you wouldn't stop the presses because the company raised at $1 billion anymore. That's not the world we live in. And so it's this weird paradox where investors now know that you can get companies that are worth 10 or tens, plural, of billions of dollars as private companies, which means that if you are a $1 billion company, you're now slightly less interesting to investors than the company that could be a $10 billion company, which means that the margin, the scale of the opportunity you're going after as a founder has to be that much larger in some cases to get investor attention. And that, I think, has lots of profound implications for who gets funded and why. And so I've just talked to a lot of founders who are like, I don't get it. I read these stories in TechCrunch about these monster $100 million rounds for these companies that have no revenue, or just launched, or they raised 50 million bucks pre-launch, and I can't even get $1 million. And I've got an MVP and some early data. What am I doing wrong? And I would say you're not doing anything wrong. The market just isn't necessarily looking for what you're doing yet. And there's so much focus on this very small number of companies that can be worth north of $10 million, that like so much energy in our business is focused on finding those, that if you're not one of those, you can get overlooked.
Yeah, wow. That is such a good note to end on, is that sometimes it's not that you're doing something wrong. It's just where the market is. And so don't, that doesn't necessarily mean give up, but it might be find that funder who is interested in what you're doing. And it might not be everyone, but there might be someone there. Now, I know we are coming up to time, so I want to do something that's a little fun, a speed round of questions that I think a lot of folks as entrepreneurs are thinking. And so I'll ask the question, we'll go in a line and just have each of your perspectives. All right, so it's the first pitch, slide deck or no slide deck? Charles, do you want to start?
Probably slide deck.
All right, Dina?
Slide deck.
Ryan?
With me, they usually don't have a slide deck. Yeah.
All right, so 2 slide decks, maybe 1 node slide deck. All right, pitch your favorite VC first or save them to the end. Ryan, what do you think?
End. Yeah.
Dina, what do you think?
Whenever you can get the meeting.
Love that. Charles, what do you think?
Middle.
Middle. Okay. End whenever you get that meeting, or middle. All right. So
like the Price is Right.
what we're seeing is
Here's
there
my
might
car.
not be a right answer here. Okay. Best way to get a meeting with a VC you don't have a connection to. Dina.
I love the cold email, I'm not going to lie, but you got to show value. Don't just ask to pick someone's brain.
All right, Charles, what do you think?
Cold email is probably number one. 1B is if you happen to know a founder in our portfolio, I always pay attention to their recommendations.
Ooh, okay. So cold email, maybe cold email a founder and get that intro. Ryan, what do you think?
Cold, always cold. I love the cold emails.
All right. So don't discount the cold email, just make it targeted. Okay. Next question. Raise more or play it conservative in how much you raise? Let's go with Ryan.
Always more. You're always going to need more money.
All right. Charles, what do you think?
I guess I would say in general, raise the right amount, which tends to be probably closer to conservative. I've just seen more companies in the early stages, pre-product market fit, raise too much money and bite off too much as opposed to bite off too little.
Dina, what do you think?
Raise the right amount, but with the right people. So just because you can get someone to write you a massive check and that's not going to be helpful to you, then you don't do that. But if you need to raise a little bit more to bring in a game-changing investor, worth it.
Amazing. Well, that was the last question in the speed round game. Thanks for playing. And it's clear that there is no right or wrong answer. So I do just want to give a space for everyone to say one last piece of advice that they want the audience to walk away with. So Ryan, I'm going to start with you.
Yeah, I always focus on one of the hardest things, especially for scientists, but I think for many entrepreneurs, is to give yourself permission, right? Like give yourself permission to start. Because I think a lot of us suffer from this fear of like, what if it fails? What if it doesn't work? Like on your deathbed, you won't regret the things that you did and failed. You will regret the things you thought of doing and never did. So I would say give yourself permission. Try it. Do it.
I love that. Dina, what do you think? What's the last piece of advice you want to leave the audience with?
Hang in there. Just stick it out. It's going to be hard. It's going to suck. There's going to be glorious moments and a lot more that aren't. And hang in there for yourself and your team.
Wow. All right, Charles, last piece of advice you want to leave the audience.
I want to pick up on something Ryan said earlier, which is run your own race. Like you don't really know what's happening inside of anybody else's startup. Even if you do, you can't do anything about it positively or negatively. And so much founder angst I see comes from like, what's that saying, comparison is the thief of joy. Like, you can only control your own startup. Like, stay focused on the things you can control. You're going to have your own unique bespoke journey. Don't worry about other people.
Wow. I couldn't come up with better pieces of takeaway than clearly could not have, because I needed to hear all of that right now. Give yourself permission, hang in there, and run your own race. Charles, Dina, Ryan, it has been such a pleasure. I've learned so much. This has just been incredibly valuable. Thank you so much for spending time with us, and I hope the audience found it as valuable as I did. I'm sure they did.
Elise, you're a great moderator. I think you should have a future in talk show hosting.
Oh my goodness, thank you.
100%.
Great questions, Elise. Great questions.
All right, thank you all so much.